Hello and welcome to Edison TV. Today I'm joined by Stephen Tredget, who is partner at Oakley Capital, the investment advisor of Oakley Capital Investments. Stephen, thanks for joining us today.
Thanks for having me on.
Firstly, thank you for participating in our recent panel discussion on listed private equity. Today we will focus on Oakley Capital Investments. So maybe you can start by discussing Oakley's sweet spot in terms of investment targets.
Absolutely. So just to confirm, OCI, or Oakley Capital Investments, is the listed investment company, and it commits to the funds managed by Oakley Capital. So it's a direct PE play. So describing Oakley Capital's sweet spot, well, they take typically controlling stakes in private, fast-growing European companies traditionally. And a kind of a typical, there's 28 of those now underlying companies. And if I was to kind of describe very briefly the kind of 5 things a typical kind of Oakley Capital deal will be, what is our sweet spot, as you ask? It's 1, pan-European. It's going to be under $1 billion or $2 billion in enterprise value, and it will sit in one of 4 sectors: technology, and that's infrastructure as a service or software as a service; education, and that's from the first day of your education right through to industry training; consumer digital, price comparison websites, property portals, that kind of thing; and business services. They're mission critical services, often with a regulatory theme behind them. Most importantly for us, and the second point, they're founder-led businesses. So we are back and proven business leaders who are investing alongside the same terms as us. And we're often, in 90% of the cases, we're the first institutional private capital entering these businesses. And in 3/4 of the time, it's an uncontested process. And that means we're getting into really interesting businesses and really attractive valuation multiples where there's heaps of opportunity to create value. Thirdly, they're going to be digitally disruptive businesses. So they're going to take market share rather than relying on market growth. And there's often a level of recurring or subscription revenue to these businesses. They're quite resilient in difficult economic environments. But ultimately, we're a thematic investor. So this is really looking at opportunities that fit with themes, trends that we think are enduring. They might be business migration to the cloud, of which there's plenty of white space to do that with across Europe. Growing demand for high quality education. We back schools, businesses, for example, globally. Consumer shift to online, particularly in Southern Europe, where those kind of solutions, for example, property portals, are 5-10 years behind where they are in Western and Northern Europe. And then providing mission critical tech enabled services into industries like law or regulatory compliance. And then finally, there has to be some way for Oakley to influence the investment outcome through value creation. So this is the great thing about being control investors, that we're going to come in and affect the outcome ourselves through helping with M&A, digitalization, internationalization, talent, or generally trying to improve the quality of earnings.
Thank you. That's very helpful. And now maybe you can talk us through your 2023 results, which you've recently announced, and the performance of your portfolio companies.
Absolutely. I guess there's kind of 3 things that kind of stood out the year that's just gone. The businesses themselves continue to perform well, and they drove asset value in a particularly challenging macro environment. The interesting thing about a challenging macro environment is it creates great investment opportunity, and we've seen Oakley make a significant number of investments over the last kind of 3 to 4 months because of that, which is already laying the foundations for future growth. And then we've been committing to new fund strategies, and the one that's of particular interest is an AI-powered software fund called Oakley Touring Fund. The headline numbers: NAV per share is 684 pence to December 2023. That's NAV of 1.2 billion. So OCI is now getting to a scale above $1 billion, where it's starting to be more meaningful, and hopefully with that comes more, with size comes more liquidity, and the opportunity in time to move to the FTSE 250. That's based upon a portfolio completely revalued to December 2023. And when you include dividends, that's a total NAV return of 4%. Now, 4% for those that know OCI well is a relatively modest annual return. We've averaged NAV return and total shareholder return in the 20s for the last kind of 5+ years. And that return reflects, yes, a bit of trading headwind, but also a particularly conservative view last year in the terms of the prospects of this year. So we've been conservative about valuation, but also in terms of our budgets. Hopefully that will prove to be a very conservative stance and then one that valuations will benefit from in 2024. There are 28 investee portfolio companies as we sit here today, and their average organic weighted EBITDA growth was 14%. Which, when you consider the current climate, is a good, resilient earnings growth across the portfolio. It came from across the portfolio companies, the performance, and across the sectors. If I pick out some examples, there's IU Group, which is an online university headquartered in Germany. They saw continuing demand for their courses, with student enrollments up 33%. Within the consumer sector, we saw Southern Europe's #1 property portal, Idealista, and one of the world-leading water sports business, North Sails, both beat budgets last year and saw valuation uplift as a result. And then in business services, we own one of the largest testing and inspection businesses, Fenner, which saw value creation both from their organic sales growth, which was strong, and also significant M&A.
Thank you. You've mentioned IU Group, where you've made an exit and partial reinvestment last year. So maybe you can discuss this transaction in more detail.
Absolutely. So IU Group we acquired in 2018. This was a university at that stage entirely focused on Germany and was launching this online degree solution. It had about 15,000 students and was doing approximately 15-16 million of EBITDA. Fast forward to this year or to last year, and that is now a business servicing up to about 140,000 students and generating, kind of in excess of 100 run rate, 160 million of EBITDA. So you get the sense of the scale and the success over those recent years. Fund 3 was coming to the end of its life. It also didn't have any additional funding available to give to IU, which was looking to internationalize and have the ability to have degree awarding powers outside of Germany. It now has that in the UK and Canada, but is really looking to kind of take advantage of demand for its high quality and accessible online degrees globally. And so a combination of those two factors means that it was time for Fund 3 to exit. So that decision was taken and a process set up accordingly. A separate investment committee at Oakley then considered if it made sense to invest again in the organisation, and it chose to. So Fund 5 took a separate stake in IU Group alongside a continuation fund, single asset, only invested in IU, which raised about 1.1 billion from a collection of large global institutions. So as a result of OCI's investment in all the Oakley funds, including Fund 3 and Fund 5, it saw an exit from Fund 3, sorry, and it saw a reinvestment in Fund 5. So it continues to remain invested in the next stage of growth of IU Group.
Thank you. That's very interesting. Now, you've mentioned that Oakley funds have been quite active in terms of new investments recently. So maybe you can discuss one or two examples of new investments, right, and themes around them.
Certainly. If we let's look to the two most recently announced. So there's Steer Automotive and Liberty Dental, and to touch on those briefly. So Steer, we signed in December. We took a majority stake in one of the largest and fastest growing independent collision repair groups. It's a business that was founded in 2018 by a serial auto entrepreneur, Richard Steer. Now, one of the particular reasons why I mentioned this one is it's unusual for us in that we haven't invested in the UK that much until last year. So one, that's kind of signaling that we're seeing value and quality and interesting, and in a market that's often been heavily competitive for PE investment. And so the current market environment is providing us with kind of fresh opportunity. And then secondly, car repair shops doesn't sound particularly Oakley, given the kind of 5 factors I've given you. Doesn't sound particularly digitally disruptive. But Rich's approach to the industry is, so to describe that, Steer acquires on single-digit multiples the typical single-site repair centres that exist throughout the country. And it systematizes their operations. And in doing so, they achieve site accreditation with car manufacturers. In fact, it has the highest number of approvals in the industry. And then they qualify in turn for access to work for the insurance companies to whom Steer is a key partner. And the outcome, which is truly impressive, is that they can double the margin of a site inside 12 months and grow the revenues by over 100%. And so with just over 100 sites today, repairing over 115,000 vehicles, Steer already has created one of the largest national networks in the industry, but it still only has a fraction of the market. There's 3,500 independent repair centres in a market worth 5 billion. So they really are only scratching the surface. And we've come on in order to help grow that business, identify opportunities for M&A, and kind of bring on new talent around Richard, and potentially in the future look to internationalisation. And then I mentioned Liberty Dental, another business service deal acquired in the year. It's the acquisition of 3 dental labs, which we carved out of European Dental Group. Again, we've backed the founder to do this. What does the company do? It provides a range of services, including the design and manufacture of dental prostheses and orthodontics. And it's utilising technology, including kind of CAD software and computer-aided milling and 3D printing, as well as local craftsmanship. And through Fund 5's investment, the company will benefit from Oakley's extensive expertise in digitalisation, helping the company to capitalise on technological innovation in the dental lab industry and the rapid digital transformation of this market, which we see is going to give us the opportunity to consolidate an industry that has never previously been consolidated. I mentioned we're partnering with the founder, very typical for us, Hidde Hove, and the collaboration with Oakley and a very experienced management team gives us the opportunity to target ambitious growth, not just organic, but more importantly, international expansion and targeted M&A.
Yes, thank you. It was quite interesting to hear about those buy and build opportunities. Now, I think it would be also helpful if you could discuss the balance sheet headroom for further investments this year.
Certainly. So if we look at the cash on the balance sheet as of the end of the year, there was £207 million of cash. And then in addition to that, there's a revolving credit facility of 175 million. So total liquidity of 382 million. Now, how does that compare to commitments to the funds? Well, there is about a billion of outstanding commitments. Now, that sounds like a particularly big number compared to our liquid resources, but that is a number which will be deployed over the next kind of 5 years or so. So in reality, there's about, of that, 250 million, which is expected to be called over the next 12 months. After that, there's about 500 million that will be called after 12 months and within a 5-year period, and about 240 million that's not expected to be called for a variety of reasons. You don't often deploy the entire fund. You leave contingency, and there's funds now that have come to the end of life where we know that additional capital is not going to be called. So liquid resources can reasonably expect to provide kind of 1 to 2 years of drawdown cover if the funds, and it's important, were not to generate further proceeds during this time, and the fund continues to invest at a high level. Now, in reality, we anticipate that we will see further realizations in 2024.
Thank you. You've already mentioned that you recently launched the Oakley Touring Fund. So maybe you can discuss its focus and also how it fits into the investment mandate of the other Oakley funds.
Certainly. So the mandate is to invest in Series B plus. So these companies are companies that they're established, they have a product, they've got annual recurring revenue, they're very much in growth phase. The companies, the angle we really wanted to exploit was getting behind generative AI and the disruptive impact of generative AI. As an advisor, Oakley has successfully participated in the previous kind of paradigm shifts. So the advent of the internet, the smartphone, the cloud, and this is very much, in our view, the next big material shift. And to do that, we have partnered with a team that have built 3 global venture franchises, including Qualcomm and N12, Microsoft's venture fund. So this is a team incredibly experienced. They were the early backers of Zoom and Kahoot and Waze, so good international experience. And what they and we are focusing on here is investing behind AI-powered software solutions, adaptive, consumerized software solutions that are helping to revolutionize lots of different verticals. And so even in the first just 6 months of investing, that's exactly what they've already managed to do at a point in time when there's probably a lot more attractive venture evaluations currently in the market. And they've gone into cybersecurity, fleet management, and digital marketing. And so how does venture fit into what is predominantly a buyout kind of fund strategy? Our view is it's not about Oakley managing bigger and bigger funds and doing larger and larger deals. It's not where our expertise lays. It's not where our value creation levers lay. We're much more interested in backing founders across the life cycle of a business. And so now the fund strategies achieve that. We have Oakley Pro Founders, which invests at seed level at the earlier stage of a business inception. Then we have Oakley Touring investing at Series B plus, so the kind of growth phase. And then we have the buyout funds when you've got more established profitable businesses and you're investing at lower mid-market and the mid-market. I think it's worth saying, look, this is a small part of the Oakley portfolio today, tiny. If you look at the total investments you consider to be in venture, they amount to kind of 20 odd million pounds of 1.2 billion. But I think it really does represent huge option value for OCI. And in turn is allowing Oakley and the rest of the portfolio companies to really participate in the shift. So the team and their knowledge is helping to inform the AI strategy of the broader portfolio companies.
Thank you. That's very helpful. And finally, maybe you can discuss the prospects of the portfolio companies and also the road ahead for Oakley's activity.
Absolutely. So I think we just look to performance. I think the fact that you've got a resilient portfolio with the characteristics that I outlined earlier, if they were growing at 14% organically last year in a relatively difficult macro environment, we can be confident of another robust performance this year as our baseline. Now, I happen to think we're being pretty conservative about what that performance is. So hopefully there's upside to that budgeted performance, particularly if the market environment proves to be more positive than it did at the end of last year. And so that will continue to kind of driven by earnings growth, the kind of NAV forward again. There's also one of the things that really helps drive the NAV is realizations. And I think looking at the current portfolio, we can expect realizations between kind of 2 to 7 in number. And what's attractive about a realization is, one, it helps prove the NAV. Our asset valuations are what we say they are. And if you look historically, we have sold assets kind of 50% above the book value and where we're holding them. So they in turn can prove to be a trigger for value creation. And then of course you've got this really positive environment for investing. And so we think the existing portfolio and the opportunity to put new platform deals in place should all kind of benefit this year, kind of giving the prevailing environment. So in short, the outlook looks positive for OCI this year and in the years ahead.
Stephen Tredget, partner at Oakley Capital, thank you very much for your time.
Thank you.